Welcome back to Morning Trade Live. Earnings around the corner and banks will kick it off. So let's start there. Dick Bove is back with us, senior research analyst at Odeon Capital Group. Tom White's going to do some trading with us here in studio. Dick, welcome back to the program. I want to start by talking Wells Fargo because I'm reading your note and it looks pretty darn bullish.
Yeah, well, I think that the guy they picked for the job was exactly right for them. In other words, if you take a look at Charlie Scharf's career, he seems to be a guy who loves to take on huge challenges and then gets bored once he's resolved the problem, and he doesn't want to sit around and wait to see what happens. He's done that at Bank One. He did that at J.P. Morgan Chase. He did it at Visa. He was starting to do it at Bank of New York Mellon, and therefore not only does he have the right characteristics for what Wells Fargo needs, but, he knows the business inside out, having worked on both the retail banking side and the, if you will, technology side of banking. So I think he's the right guy. Plus, Wells Fargo is sitting here with 70 million customers. It does have just under $2 trillion in assets. All it needs is someone to light the fire again, and I think the stock should go significantly higher.
What are going to be the limitations of the size that this company can attain now after the controls that were placed on it following the scandals? Is that a limiting factor at all in how this company can grow, or can they still keep moving the dividend higher and helping the bottom line, all the things that you typically want from a stock?
Yeah, no, I think that if you think about the fact that this company has to do some slashing and burning, and that's exactly what I think Mr. Scharf will do. He will go in and eliminate a whole series of businesses that have not been producing reasonable profit for Wells Fargo. I don't think there's any limitation on their ability to grow profits, if you will. I think that it's going to be a change in mix more than growing assets, but there's been a lot of talk about Wells Fargo not being able to increase its lending. That's not true at all either, because Wells Fargo is the number one mortgage lender in the United States, and they can keep originating mortgage loans forever and selling them to Fannie and Freddie. Wells is one of the largest, it used to be the largest, but one of the largest lenders to small businesses. And again, the SBA mechanism allows them to sell those loans if they have to. But I don't believe that they're going to have to. I believe that, number one, that they'll continue to grow their businesses. They will get rid of businesses that are weak. And number two, within the next 12 months, my guess is that this limitation will be lifted by the government.
Does it, to me, it kind of sounds like, Dick, when you look at what Mr. Scharf is going to be doing, that we might expect some headlines from this company over the coming months then that might, to some, look alarming, whether it's going in and, slash and burn and laying folks off. I mean, are there going to be headlines about shrinking size and, things that otherwise might look negative? Are those going to be a positive if and when they arrive?
Well, if you think about, Citigroup or J.P. Morgan Chase or Bank of America, the three main competitors, you will see that over the last, 10, 12 years, every one of those companies have redefined their businesses. And, in the case of Citigroup, it sold, literally $1 trillion worth of revenues or assets, in terms of businesses that it got out of. At one point, Bank of America admitted to having sold 76 different businesses and portfolios, and J.P. Morgan, has constantly reshaped its portfolio, and lately it has actually been refusing to grow the portfolio because it's been selling, loans. Wells Fargo never did any of that stuff. Wells Fargo just kept building and building and building and acquiring and adding. It never went through that business. Although Tim Sloan did start doing it a little bit, it never went through that company and reshaped it. That's what's going to happen now. They're going to do exactly what Citi and J.P. Morgan and Bank of America have done for the last 10 years and what they should have done over that 10-year period. And I think that, it's just like Goldman Sachs. Goldman Sachs is completely getting rid of the old, if you will, methodologies that were being used in that company and building new businesses while they're they're actually getting rid of 1 out of every 6 of the top management people in the company. Wells never did that stuff. Mm-hmm. And I think that stuff is absolutely necessary, and I think that's one of the benefits that Scharf is going to bring to the company, and one of the reasons they had to get an outsider to run it. They gotta reshape this company.
Dick, last point here. You and I have discussed loan growth still positive on an annual basis. Now, if the economy continues to remain strong, let's say the housing situation continues to improve, the catch I'm wondering with Wells Fargo, though, is will they be able to keep up with new customer acquisition and loan growth if there is still a stigma when somebody has a choice to go out and get a loan somewhere? Are they going to choose Wells Fargo? Are they going to choose a competitor?
Well, I think, we're seeing that they have not been able to keep up with what's been going on in the industry for the last 2 years. I mean, they have not generated savings to the degree that they should, deposits, that is, to the degree that they should have. They have not grown their loan portfolio at the rate that they should have. Quicken is catching up to them and passing them in many cases in the mortgage area. So, I don't think you can turn that around immediately. But I do think if you keep your 70 million customers, and if you're sitting with, I'm going to say $2 trillion worth of assets, and if you have, what is called the Common Equity Tier 1 ratio above 11%, you got all the elements there. Yeah. You got the customers, you got the money, you got the need, and I think that Wells will start to catch up again.
All right, Dick, always a really good take here on the banks. We're going to do some trading now based on that. Dick Bove with us. I want to bring in Tom White, who's going to talk some execution. All right, so we've heard the bull case here for Wells Fargo. Right. Tom, you've looked at the options market to figure out how to put this to work. Tell me what the trade is.
Yeah, so if you look at it, stock's now up about 10% year to date after that big pop we saw post-announcement. Morgan Stanley actually just came out with a note on Wells Fargo right before it came in, and they said, this is a nice acquisition by them with the CEO, but we still see this stock hanging out around $50.
All right, so an opposing viewpoint there.
Yeah, and Dick said, he likes the banks, but they don't trade a lot around earnings. So I went out to the October series. Wells Fargo reports on the 15th of October.
Okay, so you have 3 days after this.
Yep, and this goes out to the October monthly series, so you capture that earnings event. Now, that being said, there's a possibility that can move pretty violently on earnings, but banks historically don't move that much, just based on what we've seen on price movement post-earnings. So what I went out and did was looked at the October, an iron condor in here, and this is also called an iron butterfly because I'm using the same middle strike where I'm selling the 48-51 put vertical, so I'm selling the 51 puts, buying the 48 to make it risk defined on the downside, but then I'm also selling the 51 calls and buying the 53 calls, creating a short call vertical. So you got a common short straddle in the middle on the 51 strike, and then to protect yourself on the outside, you're buying a strangle in there in the 53-48 call and put. And you see right there what we've got, Oliver. So I skewed it a little bit to the upside to take advantage of if it does start moving higher post-earnings. Where I've got only about $40 in risk on this particular trade because I'm collecting a $1.60 credit. My call vertical is only $2 wide, so that puts a risk at only about $40 per spread to the upside, but I've got more risk because my put vertical's $3 wide to the downside. So now you see the break evens there, $49.40 on the downside and $52.60 on the upside. So it's skewed a little bit to the upside, but you're taking advantage of higher volatility going into this name, which allows you to collect that $1.60 credit, which is the most you can make on that trade. But I like the width of the break-evens on this, but you're still risk-defined going into earnings.
Okay, so here's the neutral to bullish, right, for Wells Fargo. Let's talk Morgan Stanley, though, another bank here whose shares really have not been performing as well as some of its peers.
Right.
As JP, Wells Fargo, and some of the others trying to break out.
Goldman Sachs especially has outperformed.
Yeah, Morgan Stanley is at $42, which is basically in the middle of a range it's been in for like an entire year, bouncing up and down.
Right. So I
read catch up. How do you play that?
Yeah, I've read through Dick's notes, and I looked at a simple strategy using Morgan Stanley because they also report earnings later on this month. And what I wanted to do was just create something to take advantage of that dividend yield, which is 3.25%.
Right.
So you got a nice, solid dividend yield
Wells
there.
Fargo's about 2.
Yeah, exactly. So to take advantage of that, and this stock's only up about 8% year to date, so it's severely lagged a lot of its competitors. And the IPO market and the underwriting, they're going to probably make some decent fees on those. So I went out to the October series, I sold the 44 strike, and then I bought the stock on this. So creating a simple covered call strategy where you own the shares, every 100 shares that you own, you sell one call against that based on how much you want to put at risk.
Okay.
You're roughly paying about $42.25 debit for that, which is your break even to the downside, which is currently below the share price. So that allows you to actually collect option premium going into this. And you see the break even at $42.25. Your max loss, $42.25, so it is more capital intensive than doing just options in general. Max profit, $175, but that can increase because you'll have the ability to buy back your short options, keep rolling those as long as you own the shares, and if it continues to go higher, you might get your shares taken away unless you roll or just close out of that position. But it is a bullish type strategy, but also you get that pop from the dividend yield by owning the shares.
Okay, and it's to correct myself, I misspoke. Wells Fargo's got a $4 dividend, which means it's actually 4% yield, a little bit higher than MS, but all the banks generally 3 to 4%.
Right.
Pretty high dividend. All right, nice, Tom White, looking at the trades here. Thanks to Dick Bove, again, research analyst at Odeon Capital Group.